Sticking with consumer names, our next guest says the key for investing in them is to stay selective. Let's bring in Avery Sheffield of VantageRock back with us. Nice to see you. So
great to see you, Scott.
This was an interesting week for retail.
Yes.
Sort of ending with a whimper.
Yes.
The way that Foot Locker is trading, kind of overshadowing everything today. But how do you view it now?
Right. So, I like to be optimistic about the consumer. I think the consumer is an increasingly tough spot. And we've seen multiple data points through the week, certainly this morning and previous reports, even at the higher end, reports by companies like Canada Goose, like Burberry, showing that the U.S. consumer at both the higher end and the lower end is struggling more.
Are you, by and large, worried about the consumer enough to say, you know what, maybe it's too hard to be too selective, so why bother? Right.
So we're watching very closely. I think it's not why bother. I think you want to be a very prepared mind. So what we're doing is we're spending a lot of time looking at companies, not just the companies that you know that are going to sail through this fine, right? Walmart's going to sail through this fine. It's an expensive stock. Like, they reported great results. The stock's not up. The TJ Maxx, like great companies. But looking at the companies that are more sensitive, are more beaten up, but are likely to, or that have the potential to really outperform and have enough going for them that they can surprise onto the upside over the coming year, like, that's where there are going to be opportunities. But the pressure on the consumer looks to be accelerating, not decelerating. So I think being a prepared mind is potentially the best place to be.
I mean, I ask you the question because, on a day like today, I look at Foot Locker and I'm like, okay, Foot Locker's got its issues and it's talking about bloated inventory and you got to have markdowns and more of them because they have to work through it. And then you look at Nike's down almost 4% in sympathy with that. So do I need to think differently about the Nikes of the world if I'm worried about the Foot Lockers of the world?
I think I would think differently about some of these very expensive, great brands that are also potentially cyclical. I mean, we did see with Under Armour's earnings, certainly not perceived to be the same brand, had the same brand strength as a Nike, but we haven't had any data points yet, on the largest footwear company in the world. And, it's hard for me to imagine that, given that Foot Locker has, 65% of their sales from them, that they might not experience pressure too. And then the question, of course, with all these big brands is, how is China going to do? How is Europe going to do? But if you see some weakness there, there's a lot of room for multiple compression.
Are you reassessing, as it comes to retail, the rebound from China has been weaker, I think, is fair to say, than some thought, particularly from a travel retail standpoint, right? Estee Lauder comes to mind. You're thinking now differently?
So I've been more cautious on the China rebound myself. I think it's been there have been a lot of differences across brands, right? So companies that had that both maybe produced too much inventory themselves or had customers like in travel retail that bought a lot of inventory ahead, expecting a very strong rebound, they are struggling. Those that have managed their inventory more tightly, actually look like they have decent results in China. How long that will continue, I think, is a question. But you have to look brand by brand and at their inventory levels and their potential sell-in over the previous quarter to know, I think, where you're going to continue to see benefits.
You buying this AI move? I mean, how do you think about it? Is it a bubble? You're laughing. I mean, why are you laughing?
I'm laughing because it seems very bubble-like, but the bubble keeps growing, right? So it does seem like .com, it does seem like Bitcoin, because as soon as AI came out, I asked the CEOs of every company I was speaking to, so tell me about your investments in AI. And they said, oh yeah, we've been investing in AI for years. Oh, has your CapEx budget changed? Not really, maybe a little bit on the margins. And so it seemed more incremental rather than revolutionary. Certainly, companies are going to be spending more money on it, and you are hearing about incredible demand for the chips. But will that materialize into the revenue and earnings expectations people are thinking over the next 5 to 10 years? I think that's going to potentially be tougher. But what's going to stop it? I don't know, because demand is accelerating. It's just I'm not seeing enough use cases that suggest there's going to be enough investment to justify the current valuations. And also what's interesting at a chip level is you are seeing the primary purchasers of AI put out announcement after announcement about their own internal initiatives that they think are going to actually be better than the dominant players' chips over time. And that suggests there won't be a monopoly, and spending might be lower than anticipated due to cost efficiencies.
But it makes you pause, if nothing else, and say it feels a little reminiscent of that early run-up in some of the stocks, even though, let's be clear, and we showed this earlier in the week, the valuation gap between then and now is extraordinary. Extraordinary. Yes. In the early days of the internet leadership stocks, if you look at those, I don't need to mention the names, but people remember what they are and how crazy the valuations got. I mean, is Microsoft at 30 whatever times earnings is not nearly as egregious as something like that. Maybe in the current environment, just relative to, where rates are and what the trajectory for that and the economy are, I can see that argument.
Yes. Look, Microsoft might be an expensive stock, but Microsoft's not a stock that's going to fall off a cliff. I mean, they've got a lot of good things going for them independent of AI, and AI is likely to be, I think, very value add for them. It's just a question of what multiple you want to pay in a market or in a world where short-term interest rates are 5.5%.